We'll go ahead and kick it off. April, like she mentioned, we've got people from SMPS Idaho and across the country. So thank you everyone for participating in this event. Happy that web can reach so many, especially for a topic like this. So we all know marketing matters, but finance matters too. So this particular conversation is all about the profitability, about our marketing groups and how we can support our technical colleagues in that way. So Chris Rickman here is happy to provide provide information and kind of guidance on this important topic. So Chris, I will let you introduce yourself. I think you can do it better than I can. So take it away.
Yeah, no, Chris Rickman, fellow of the Society, certified professional services marketer, currently work for Fremont-Wright. We are essentially a collaborative of various different AE design firms across the country. Those firms that are under our umbrella, they still operate under their own brand, but they are actually under our umbrellas. We've got a firm in Idaho and Las Vegas and Salt Lake and firms in Florida. So I mean we Fremont-Wright is it's essentially all over the country, but I've got well over 30 years of experience in the industry. Most of that time was spent working for a local structural engineering company where I grew from a CAD technician all the way up through one of the managing principals. And obviously operations and finance was under my privy since I was not a licensed engineer. So this topic is near and dear to my heart. I'm not a CPA, so I'm not going to throw out a bunch of language that maybe you all may not understand or comprehend. So I'm hoping to bring it to something that you all can grasp onto as we go forward. And I'm going to do my best to take a few pauses so I can answer some questions, and I'll again try to watch the chat box. So don't hesitate to stop, interrupt me, ask a question. I'm flexible. I don't mind any of that. I want to make sure that what I'm presenting to you is valuable and that you can take it back to your firms. So looking at us as individuals, if we think about it, most of the marketing folks, they're kind of those right brain folks, right? That creative side. And that left brain side is really where most of our principals or our accounting people live. That's the logic side, right? My goal today is to not move you all from being that right brain person over to the left brain. My goal today is to bring you somewhere closer to the middle to where you can still obviously live where your passion is, but understand the logic and numbers behind what we do as an industry. Some of what I may say may sound like this to you, right? That's not a good thing. That's not what I want. Again, I want you to leave here with smiles. I want you to leave here understanding. And so if I didn't cover something well enough or you just have questions, again, don't hesitate to stop and ask, and I'll do my best to answer the best that I can. So, it is exciting that you all, raise your hand and say, hey, I really think this is important for me and I want to sign up for it. But, you may have been asking, or somebody may have asked, well, why do you need to know that? That's not your job, right? But the more you know about, the finance side and how things operate and how things are calculated or whatever, obviously we can all be more effective in assessing those clients and projects that we're pursuing, right? We all want to be more profitable. We all want to make sure that we're making the right go, no go decisions, and we have information that can back that up. So the more we understand, the more we can be effective in pursuing those projects, those clients or projects. And I don't know about in you all's area, but certainly here, before COVID and probably even now today, more and more of the owners were requiring financial information be provided with the RFP process. And so the more that you can get started or the right questions to ask your accounting people, that will help you in putting your RFPs together. And as we all know, you have to understand this if you want to climb the ladder to that C-suite. If you want that seat at the table, you have to understand the fundamentals of your firm's finances. And it's all about creating more value. You're going to create more value for your firm. right? Because we're trying to be more profitable. You're going to create more value for yourself and certainly our profession, right? You know, the um, we've got to continue to grow our profession and making sure that we have a voice and we understand the importance of that. And it's all about growth, right? Business transformed through marketing leadership, right? That's the SMPS vision. And so we want to continue that and know that we are helping to try to transform our businesses through our marketing leadership. So as we go through today, you know, some of the things we're going to cover, I'm going to give you a little bit of basic terminology. We're going to talk a little bit about planning and how to potentially look at ROI. We're going to talk some performance. I'm going to give you some metrics and some calculations, and I'm really going to cover kind of three important ones that I feel in our short time that we have together. And then we'll go through how to make your firms more profitable and what to look for and how to make that happen. So normally I would give a session like this in about an hour and a half. So we would cover more metrics and calculations, but I've at least included, you know, three of the important ones that we can take back to your firm that you can begin to monitor and look at as we go through it. So some basic terminology that we have. We have two types of accounting that we look at. We have accrual-based and accounting-based accounting. So accrual-based accounting reports our income when it's earned and our expenses whenever they are incurred. So what this means is if your company recognizing unbilled revenue or or unbilled income, as soon as your timesheets are approved, that income or that revenue is going to hit the income statement as unbilled revenue, right? If your firm does not recognize unbilled and it only recognizes billed revenue, that billed revenue is going to hit the income statement as soon as you invoice it. So that is accrual. Same thing for your expenses. When your expenses are recorded in the system, they are expensed in the month that they are recorded. When we talk about cash-based accounting only reports the income whenever you receive it or the expenses whenever they are paid. So, you know, as an example, it would be if I invoice a project in November of 24, but I did not receive the cash until February of 25, that income would not be reported on my income statement as revenue until February of 25. Same thing with expenses. I received an invoice from my vendor, but I did not, you know, I received it in November, but I did not pay it until December. Those expenses would be recorded in the December period. So the cash-based accounting is not GAAP compliant. So if you are a larger firm and you have to follow GAAP procedures, cash-based accounting is not GAAP compliant, and you have to follow accrual-based accounting. For my construction people out there, we have two methods. We have a percentage of completion, which will recognize the income as the work progresses. So as you're continuing to work on it, you can do a percentage of completion, and then you record that income then. Or if it's a smaller project, you can record that income whenever the project is substantially complete. So it's just basically on a completed contract. So those are accrual basis versus cash basis and percentage of completion versus a completed contract. Now we're going to roll into our various different costs or expenses that we might incur on a project or in our business. So we have direct expenses, and this is any sort of labor or expenses that is directly assigned to the job and is part of the basic scope of services. So this could be, you know, labor, subcontractors, any equipment, any insurance. All those things are directly related to a project, and so those will be direct job cost. For the construction firms, we have indirect job cost, or our, you know, kind of general conditions is kind of the term that most contractors use. And these are, you know, the contract supervision, any tools, insurances, any owned equipment, those things would be indirect job costs for our contractors out there. Any indirect cost or overhead cost from an A&E side, we call those G&A or overhead cost. So this is labor and expenses that are not assigned to a project at all. So Most of our marketing salaries are going to be that way. Any sort of rent that we have is going to be an overhead expense. Utilities, all those things go into our overhead expenses or overhead cost. And then we have reimbursable costs. So those reimbursable costs are costs that are assigned to the project, but they are outside of our scope of services. So those are essentially normally would be a pass through to your client. So, the client says, hey, I need you to go hire the geotechnical engineer if you're the architect. And you can say, okay, well, that was not part of our original scope. I can do that. And then I will just, invoice you, and that will be a reimbursable back to us. And we'll pay that subcontractor. And the two reports that you probably hear all the time, from a financial perspective, is we have an income statement or a profit and loss statement. And this is where all of our revenues and expenses are recorded for any period, right? So any and all of our revenues are going to be recorded here, and and all of our expenses are going to be recorded here. And it's essentially from a calendar year, or depending on if you're on a different cycle, if you're a July to June, that's when those expenses are recorded. And then whenever your fiscal year or your calendar year resets, then your income statement accounts will all reset to zero, and then you will start over for the next year. And you'll typically report these, most people do them monthly, but you might see some people do them quarterly or annually, depending on what your bank requires. And when we talk about net income, net profit, whatever that is, all that is you're taking all of your revenue minus all of your expenses, and that gets you to the net income or the bottom line. So that's where that comes from, and that's why it lives on the income statement. The balance sheet is where all of the company's assets and liabilities live. And that is from day one, from when the company started. So that the accounts in the balance sheet never get reset. It is a rolling accrual from one year to the next. So, if you've got, when we talk about assets, this is typically our checking account or our accounts receivable, or, any sort of, equipment assets that we have, or building or anything like that. Those are all assets that get, they work through over time, but when I get to the end of my calendar year or my fiscal year, those don't reset to zero. That's got to continue forward, so I can continue to work against that. Same thing with liabilities. It's all, working through. So assets are things that we own. Liabilities are things that we owe. We owe money, or we owe something to. So that's a liability. And so when you're looking at the balance sheet, if you see, short-term liabilities or short-term assets, those are things that are generally going to be converted in 12-month period. So that's why they're called short-term. Then long-term assets or liabilities are things that are longer in that 1 year period. So you may have a 3-year note on an equipment, purchase that you had for your firm. That would be a long-term liability that you're going to pay out over that 3-year period. So when you're seeing a balance sheet and you're seeing short-term, long-term, that's how generally that's broken out. So I'm going to stop a little bit. Any questions on any of the terminology, any of the reporting that we had, anything that maybe you've heard that you're like, hey, I want a little more clarification on that? Okay. So now we're going to talk a little bit about ROI and how, a couple different philosophies on how I approach it and how you might want to approach it in your firm. So when we talk about ROI, return on investment, in basic terms, right? We all know this, whether if we have a 401k or, we listen to the news, whatever. But if I go out and I invest $10,000 in some sort of stock and I get $1,000 back at the end of the year, that's a 10% return on my investment, right? I invested some money, I got some money back. That's a return. It's not that easy to measure in our industry, right? It's not like a manufacturing industry where I know that if I go invest X amount of money in a new manufacturing line, it's going to help me produce Y number of additional widgets I can see that, okay, over time, I'm going to return my, uh, money back in a 3-year period. So I can easily calculate that, on the manufacturing side. But there's so many things that go into play in our industry that it's really difficult to measure the true. If I go spend this, I'm going to get this back, right? It's not that transactional in our industry. And every firm could look at it differently, right? Firm A might be looking at it differently than firm B, but no matter how you look at it, I want to make sure that you put clear goals in place, because if you don't have goals in place, it's not going to be measurable, right? So I'm going to walk you through kind of a 30,000-foot look and an example of an overall analysis of your ROI. So when you look at it on an annual basis, you can say, hey, from a big picture, did the money that we spent on marketing and, return on anything, right? Did it return anything back from a revenue standpoint? And then it's going to help you evaluate, are you transitioning those marketing and BD dollars over to sales and achieving the right results? So let's walk through that and give an example. So let's say in 2022, I had revenues of $5 million. In 2023, my revenues jumped up to 5.8 million. So that was an increase of $800,000. On average, my firm has a profit margin of 20%. So that would say, if I take 20% of that $800,000 increase, I had a profit margin increase for this year of $160,000. Now, let's say for the year in 2023, I spent $100,000 on marketing. And when I say marketing expenses, that includes marketing and business development labor. It's not just, kind of the easy tangibles of conference registrations or, print cost or whatever it is. That when we talk about marketing expenses, that needs to include the labor associated with that. So you need to make sure you're capturing that as well. So if I take my net margin increase of 160,000 minus my marketing expenses of 100,000, that says my margin less expenses was $60,000. So my ROI in that exercise would be 60%. Did everybody follow that scenario? Any questions on how I got there? Kind of making sense, at least so far, on that scenario. I just want to make sure I didn't lose anybody there. But it's, again, it's good for an overall look. But how much of that revenue could you have achieved, or would you have achieved without any sort of marketing effort at all, right? Could some of that have come from, repeat client that you really didn't have to do anything to, whatever. So again, it will give you a kind of a general look, but it doesn't give you the whole look from an ROI perspective. So what if, when you're looking at this, maybe you didn't look at your ROI, or you didn't measure it by revenue? Maybe think about measuring your ROI based on your hit rates. Okay, so start putting goals and expectations around various different aspects of your hit rates. So if I have a goal of, for every 8 leads that I generate, that I hear about, whatever it is, I want to have 1 win, right? And so if I have a goal around that, and I'm beginning to measure it, and that hit rate is not where it needs to be from that, right? Am I doing the right things? Is my marketing research effort right? Am I looking in the right places for these leads? What are my networking efforts to get these leads? I can start evaluating those kinds of dollars to see, am I spending dollars in the right place to generate, for every 8 leads that I get, I want 1 win. Maybe I need to start evaluating that and making sure you're spending the right money in the right place. From an RFPs to shortlist, rate, maybe for every 3 RFPs that I submit, I want to make sure that I shortlist on 2 of them, right? I mean, that would be great. So that lets me know that I should be really prepared and I should know the client because, I'm getting shortlisted, right? And are my proposals getting through to them, and am I providing the right information, right? And then obviously shortlist to wins, for every 2 shortlists, maybe I want to win. I want to win, or, or something even better, right? For every 1.5 that I shortlist on, I want to win 1, whatever that looks like. But those kinds of measurements will help you begin to evaluate the effectiveness on your marketing efforts, on your interview efforts, on your, are you spending the money again in the right places? Are you networking with your clients where you should be? So think about, again, measuring things maybe by hit rate versus looking at just the overall revenue when you're talking about an ROI. Any questions? Does anybody, whenever they're looking at ROI, does anybody look at it based on hit rate?
This is April. I know we do. I mean, we look at our hit rate. The only flaw that I see with it is like once it goes out of our hands, it's out of our control, particularly as a sub on
Right.
Sublit, right? So we can influence it. So where I've kind of seen another additional, like you take it on proposals, perhaps in a growth area. So like, for instance, I'm growing us in Intermountain states. So I look at how much work, how many projects were we doing in the state of Idaho in 2020, how many are we doing now in 2024? You look at the revenue associated with that, do it again for Utah, Colorado. And it's another, you can like, I love how you've described it, like leads to wins, but also just RFPs to shortlist.
Right.
Like that is an awesome thing that usually gets overseen, like, or people just ignore it. Like,
Hmm.
and it's like, dude, it took a lot of work just to get shortlisted. You like
Right.
celebrate that. So I love how you've broken it down here.
Yeah. And obviously you led into, right, to my next. So what if you are a subconsultant, right? A lot of times things are out of your control. Go ahead, Katie. Sorry.
That's okay. I had a question about
Uh-huh.
RFP to shortlist and then,
Uh-huh.
a shortlist win. Do you count both, or that's something that we haven't quite figured out? If we lose the interview, but we got the shortlist, do you still count both of them, or is the pursuit in summation a loss?
Well, I think it's still one pursuit, but yes, you can track it separately. So you can say, in these pursuits, and it may be the same pursuit that tracked it from here to here to here, but you have different goals in each one of those buckets,
Mhm.
right? So yeah, you can say, yeah, this pursuit, yes, it went from, a lead, hopefully it got down to a win. So can I track that? And so you're not excluding it. If you say, okay, yeah, it went from RFP to shortlist, and that's the only place it lives. No, you can count it in each one of those buckets as long as it's progressing through each one of those buckets. Does
Thank
that
you.
answer? Does it make sense?
Yeah,
Okay,
it does.
perfect.
More validation.
Right. Yeah, exactly. So yeah, so what if you are a subconsultant, right? A lot of times, and I was one, right, working for a structural engineer, things are out of our hands, right? We can only do so much, and it's on our client, whether it be the architect or the other engineering firm, to take it over the finish line. But I think, when I look at it from a subconsultant standpoint, I want to make sure that I'm looking at, who is best positioned to win this project from an architectural standpoint. So if I'm hearing about things out there, okay, who did the master plan originally? And can I go position myself with them? Because if they did the master plan, they probably have at least a pretty good shot of getting shortlisted on the projects that is coming out of that master plan, right? So how can I position myself with them, right? Again, you can look at what market sectors are growing or declining and position yourself there. If you know you're in a market sector that's growing, hey, go spend those resources and dollars to market to those other individuals that are specialists in those areas, to let them know that you are an expert in that area. And then, track the proposal process from your clients and see if they are chasing the right projects. You want to make sure and educate and hopefully can work with clients that are not using the shotgun approach, right? You don't want to, from a subconsultant standpoint, you don't want to waste time and effort if you know that you're your client is going after it and he's just taking a shot in the dark and not going to get it because it's wasting your time and efforts when you could be focusing in on something else. And so again, to track those and start having those conversations with those clients. And if they come to you and keep asking and asking and asking and you're not winning, say, hey, this type of project is really not right for us. Come to us when you have this type of client. So anyway, just begin to evaluate those things that are in your hands and can have those conversations with your clients. And now we talk about, analyzing our clients or analyzing our projects. And so every time I give this talk in person and I ask the question, how many of you in the audience know what it's costing you to pursue a client? And very few, if any, raise hands, right? Nobody is evaluating that generally. Or, do any of you know what it cost you to propose on that project? Very few do. So we have to continue to evaluate this to make sure we can make those sound go, no go decisions from a cost of pursuit and a client profitability perspective. So I'm going to walk you through kind of an example of a proposal cost. And this doesn't have anything to do with BD in front of it. This is strictly just kind of the proposal cost back inside of when we get the notice, what is it going to take to respond? So let's look at that. So we've got so many hours to acquire it and go through it, right? We're going to analyze it. We're going to make that go, no go decision, or as in, probably most of your firms, it's always a go, unless we're strategic about it. Put a strategy together on how we're going to respond. What partners are we going to need? How are we going to staff it? Do we need any references? Produce the response, package it up, and deliver it. Now, hopefully, nowadays delivery most of the time is email, but sometimes they still want it, hard copy delivered. Whenever I do this and you start to look at it, you can say, okay, 30 to 96 hours. And if you go try to sell that to your boss and say, hey, you realize this is going to take me 30 to 96 hours to do that. You're going to be like, okay, so what? We're still going to do it, right? You're going to be more effective making that go, no go decision if you turn that into dollars. So instead of going to him with hours that it's going to take, think about it on a dollar perspective. So if I take those hours, the 30 to 96 hours, and I say on average, the people working on this proposal were at $30 an hour for their pay rate, right? But by the time I have to cover overhead and all that stuff, that $30 an hour becomes $75 an hour. And we'll get into how to calculate overhead here in a minute. So if I say, okay, $75 an hour on average for the firm to cover this, just to cover overhead, to produce this proposal, it's actually somewhere between $2,500 and $7,500 to respond to this RFP. So if you can go to your boss whenever you're evaluating this, or you're in a room and everybody's trying to make a go, no go decision, and everybody's saying go, 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 you can say, okay, great. Are we willing to spend $8,000 to $10,000 putting this RFP together just to cover, this response? And is there enough profit left whenever we put our price together to cover this and have a good profit in the end, right? That's one thing. Or you can look at it and say, okay, boss, we've put 10 proposals together for this client and we have not won one project yet. So far we have spent close to $100,000 chasing this client. Are we sure we want to continue spending money chasing this client when they haven't given us one yet? And the one that they do give us, is it going to cover this one plus the ones that we lost and have some profit? So as I said, it's so important for you to go to your leadership team with dollar figures versus an hour amount, because they'll listen to money generally. Any thoughts, questions? Agree? Say, yeah, that makes a lot of sense. I see how you're getting there. Anybody think that could be valuable? Could be a tool that they could begin to implement now as they're looking through this stuff.
This is April. I think it's
Uh,
really helpful. I haven't seen someone change it into dollar signs before, and the visual you've created here is actually super valuable because we talk about this all the time. Like, okay, this can be a lot of hours and stuff, but when you actually put it through the process that you've outlined here, it's visually, I think, going to resonate with a lot of different people.
exactly. Yeah. Like I said, if you can go to them and say, hey, happy to do it, happy to work overtime and all that stuff, but are you willing to spend $10,000 to make that happen? They
Chris,
probably have a little bit of pause. Yeah.
Chris, do you see teams tracking this based on past proposals in a particular software, or mostly kind of this rough estimate like what you've planned out here?
Yeah, depending on what your software you use, whether you use Deltek or Uninet or some other system to track, most of those systems like that will allow you to charge time to a proposal or an opportunity project. And so as you're working on this, start charging your time to these opportunity projects, and you can really begin to track. Okay, for this last one, these are the hours that we spent. This is the soft costs that were included with it from a printing and all that stuff. So for this opportunity or for this, proposal project, this is what we spent. And you can start to begin to look at those and average them. And so when you get the next one, you can go back and look and say, okay, I know we did, a similar, response for this client. What did it take us to put all this information together? And you look at it and say, okay, yeah, the last one we did for this client, it we spent 15,000 or whatever that is. So, if you're not doing that now, maybe if you don't have a system that tracks that, maybe you just kind of generically create an Excel spreadsheet and start tracking those proposals in that spreadsheet and say, okay, yeah, and just use a general number, right? I mean, this $30 an hour was just kind of an average of 60 grand a year. If you want to bump it up to 50 and include overhead, whatever, but put some number to it and say, okay, yeah, I'm not privy to, everybody's salary or whatever, but I know, kind of on average, it might take this and start. And it took me these hours. I mean, obviously, kind of your pay, and we can get to an average overhead. So if you take your pay times 2.5, that will give you an AEC average of overhead, and you can start tracking
Mhm.
it that way, right? And so okay, at least from my pay perspective, this is what it costs the firm to put this together. If you don't have a system that you can put in, opportunity or proposal type projects to track those individually in the system. But again, Deltek or Uninet both have that capability easily for people to be able to charge time to those type of projects. Great questions.
We've started pulling it out, like you were saying, in an Excel. So we'll track, the opportunity. And then for now, it's just been easiest to track marketing
Right.
hours because there's
Yep.
a more limited number of people versus, the different technical leads on different pursuits. But even tracking that has been eye-opening to go into the new ones and say, like, okay, for this agency, it's taking 42 hours of marketing time plus probably at least a dozen hours of technical staff time. And how does that translate, like you're saying, to the cost of the pursuit?
Yeah. 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 And like I said, if you can just throw some average dollar amount to it, that will again open a lot of eyes versus the hour. So you're on a right track. Now allow us to take it to the next step and put money to it and see what that does to your firm leadership, right? Great thoughts and ideas. So now we're going to get into the performance piece of this. So we talked through the planning. Now we're getting into performance, and I'm going to cover just, kind of 3 important formulas that I think you should familiarize yourself with. Try to get, information if you can out of your financial people in your firm so you can begin to look at these and help, obviously some of these you're going to need whenever you're putting RFPs together when your clients ask for it. But the first one is the overhead rate. So what this is basically taking all of your overhead costs in the firm, salaries, all that stuff included, and dividing that by the direct labor that was worked. So direct labor is labor that was specifically on a timesheet, charged specifically to any project that was billable. So all of your indirect or overhead costs divided by your billable labor. It may not have been billed, but it was marked as a billable at some point in time to a project, right? So all of your overhead costs divided by your direct labor. The Deltec average, and as SMPS members, you can get this clarity study for free. You just go get it. It's got a lot of great information on lots of different metrics, but the AE average for the Deltec industry study was 1.54, 154%. You know, during COVID, it kind of went down a little bit, probably, 10 basis points or something like that. And then it's kind of crept back up, but it historically averaged somewhere around that 150% of overhead for a firm. So we're going to walk through an example to see what is the overhead rate for, for an XYZ firm. If we had the number. So looking at our income statement, our P&L statement, when we look at it, we say, okay, our direct labor amount for the year was 800,000, and we add up all of our overhead costs, and they were 1.2 million. So what is our overhead rate for the previous year whenever I look at those numbers? So again, direct labor, overhead costs. So I take my overhead costs, all of those divided by the direct labor, and that gets me my overhead rate of 150% or 1.5. Everybody comprehend? We got it? We're good? Okay, good. So that's how we get to our overhead rate. And generally, when we look at overhead rates, it's on a kind of an annual basis, and we're looking at the previous year because it's really hard to continue overhead rate if we're in our current year. So whenever, I was looking at it and I was calculating our overhead rate for 24, I would go back and say, okay, where we were with 23, and we're going to use the 23 overhead rate for 24, accounting for any kind of anomalies that we may have had. If we had a big, expenditure in software or something like that, I could make that adjustment. But we're going to carry the 23 overhead percentage calculation into 24 whenever we're looking at our rates and percentages that way. The next one we're going to look at is our net labor multiplier. The way we calculate this is by taking our net revenues, and we want to look at any revenues that were generated by our labor only. So if we bill somebody and we bill, outside consultants, or we bill reimbursables, whatever that is, we want to make sure we're backing all that out. And we want to get to a revenue number that is generated by our in-house labor only. And then again, we divide that by that total direct labor number, by the hours only. We don't want to use the benefits or anything, only the hard pay number that we have worked on projects, that billable time charged to a project. And this is going to really tell you how efficient you are with working on a project, to that then in turn turning into billable revenue, right? So for every hour that I'm worked, is that really turning into something that's billable? So this net labor multiplier will tell you that. On average, for the Deltec study, AE was around a 2.96. So I have counseled, all, 14 of the companies that are under our umbrella. When they talk about this, okay, well, what should my net labor multiplier be? I said, well, it should not be anything below a 3. If you're below a 3, something's not right. So just that kind of gives you an idea of when you're talking with your firm leaders of, hey, do we know what our net labor multiplier is, and are we at that 3 that the average is for Deltec? So again, we're going to use same numbers, same firm, but we know that we have net revenues of $2 million, and again, we had that direct labor of 800,000. So 800,000 direct labor, 2 million in net revenue. Net revenues divided by direct labor, net multiplier of 2.5. So bingo, right off the bat, this says, oh, wait a minute, we're way below the industry average. What's going on here, right? This, when I use this in conjunction with the next formula that I'm going to give you, it tells a lot, right? It's going to tell these firm leaders a lot. So So keep that in mind. So now I've got, oh, wow, I've got 2.5 multiplier. Something's amiss here. What's going on? And the third one that I want to look at is utilization ratio, right? Now, our firms talk about that all the time, right? We have target utilization, all those kinds of things. And the way that's calculated is, and I'm looking at it here based on dollars, not based on hours. You can do it both. And it's calculated the same way, but you want to take the total direct labor, whether it be dollars or hours, divided by all labor. So when I say all labor, that's direct, indirect, PTO, any sort of other benefit time that you give, whatever all that is, anything that can be put on a timesheet, that's what goes into that total labor number. Okay. Again, it's going to vary from staff type. Most of your technical people will probably be 80 to 85%. Admin 0 to 10. If you have admin that can do things on projects and can be billable, even better. We want to get those up higher. Deltec average has been right around that 60% for many, many years. So 61.1% average for the Deltec industry study. So now let's take a look at this firm again. So I've got, again, my 800,000 in direct labor, 1.25 million of total labor, direct labor divided by total labor, utilization ratio of 64%. Like, oh, well, that looks really good. That's above the industry average of 61%, right? So you might be thinking, man, my firm is good if I'm at 68, 69%, firm-wide utilization. That may sound really good. But remember, when we go back and look at our net labor multiplier, it was at a 2.5. Okay. So as a firm leader, when I look at these together, what this says is, okay, time out. We have people charging time to a project because it's saying that it's direct time, but that time that they're charging to a project is not turning into billable work. Right. So something is happening. Do we have a potential for a change order from a client that we're not asking about? Right. Did we not charge enough? When we went in and did our fee proposal, we didn't estimate enough hours that it was going to take or whatever. And so we're going to take it in the shorts, but hopefully we can evaluate it and look at the next one to make sure that we're not doing that. So that's how these two formulas can work together to know, is the work that I'm doing and charging to a project turning into something that's billable revenue. Any questions on any of those three? Overhead rate, net labor multiplier, staff utilization. Figure out how all those work together. I know we didn't get to cover, going into how you calculate a billable rate, but when you do that, I would say when you're looking at your overall perspective and you're looking at a job cost, you want to make sure that when you're looking at job costs, okay, what was the base pay that everybody spent on this? What was my overhead included? You want to include those two together. That is your true job cost. It's not what the base pay was. When you look at job cost, it's base pay plus overhead. Am I able to cover that? Right? If I didn't even cover that, then I truly lost money because I couldn't even keep the lights on with that project. So when you look at that from a job cost, okay, now I can see, okay, what was my true profit and did I make 15, 20% like my target, or was it 1 to 2%? And we need to reevaluate that again. So hopefully I kind of gave you some nuggets to kind of go back and explore and understand and begin to look into some of those formulas and metrics that you can start to dive deeper in. And now we're going to talk a little bit about that profitability piece. How can you help your firm be more profitable? Obviously, step one is you've got to define who you are as a firm, right? Understand this, and it will help you make the right, go, no go decisions. We talked about that in the ROI, right? Making sure that you're chasing the right things and define who you are, right? Don't pursue clients or projects that don't match who you are, right? If you are really good and you're known as a quality healthcare design firm, you shouldn't be going to chase private or, private developers more than likely, unless it's, healthcare related. But, you should, most of the time that's not going to work, because you're going to spend the same effort that you're spending for those high quality healthcare design projects for these developers, and it's just not going to work financially, because they want a lower fee and not going to be willing to pay for the services that you need to provide. And then, the more you can define who you are as a firm, the client's going to know, right? You can begin to say, nope, that's not us. Go use, um, Joe Smith architects over here. They're better fit for who you are. If you have another project that's more of who we are, we're happy to talk to you and put something together, because you want that client to be happy. You don't want to go chase something, get a project, and you're underperforming, or you're providing something that he wasn't expecting and the fee is just not working out. So you want to make sure that everything like that is aligned. I'm sure that when you look at your firm's pricing strategy, many of you have heard a lot of these terms, right? We don't want to get there. We don't want to live there, right? We don't want to say, yeah, we can work for anybody, right? That's not who we want to be. Whatever the client wants to pay, that's what we'll do it for, and we'll make it up somewhere else, right? He'll give us, let's take this one and we'll maybe make it up on the next one. There's no guarantee of that next one. And if he lowballed you on this one, he's probably going to lowball you on the next one too, right? So again, we don't want to live here, right? This will help us develop a good no-go policy. Two different pricing techniques that I'm gonna walk through. We have value pricing, just again, basically going to set the value of our service, or set the price based on the value it is to the client, right? If you manage it properly, this is going to be your most profitable. Some people say, oh, T&M, well, that should be most profitable because we're charging for every hour. And not necessarily, because that the client may not have had an expectation of the hours that it was going to take. So there's going to be some infighting if that happens. So examples of value pricing are fixed fee or lump sum, percentage of construction, or we're going to do unit pricing, where we're going to charge X amount per hole that we're going to go drill, or whatever that is. Those are all value-based pricing, where I can say, okay, you're just going to get charged X, and whatever it takes me to do it, that's what it's going to take, but I'm going to charge you X. Cost base is essentially what we talked about. We're setting the cost based on what it's costing us to perform it. These are time and materials, hourly rate fees, whatever. And I would say that it's best to use cost base when you really don't have a defined scope. It's super early and you don't really know what the scope is. So, okay, let's go in and do it on a time and materials basis. And then once we get the scope defined, then we can roll that over to a fixed fee contract. That would be my recommendation. Wholeheartedly, 100%, try to do your best to stay away from time and materials not to exceed contracts. The only one that wins in that scenario is the client, right? He's only going to pay you for the hours that you're working until it hits this cap. And then once it hits that cap, you're not going to charge him anymore, and he doesn't have to pay anymore. So he wins, right? You don't get the effort of being able to increase your profit margins on T&M up to a cap. So I would say, if you're going to do it, do time and materials. Try to get those to only when the scope is not defined, and then you wholeheartedly do your best to do fixed fee contracts when you can. So I said, fixed fee or lump sum are going to be your most profitable. So how can I get there? Step one, change your contract form, right? Can you do something uniquely different than your competitors? Your client's going to see value in that and may be willing to pay a little bit more. It's a little bit harder from our side of the table, but we have to work with and communicate to our leadership team that we can't strive for design perfection, right? We have to say, this is what the client expected. This is what we have to deliver. We can't continue to go and nickel and dime this all the way down, to the fifth decimal place when we're engineering something. Let's make it safe and serviceable, give them what the client asked for, but we can't have design perfection, because we're going to continue to spend money and spin out of control. Can we do things faster and better? Let's come up with ways to do that. We all know if we increase our client loyalty, hopefully they're going to be willing to pay a little bit more because they know who you are, they know what to expect from you, and they know they can get a better service from somebody that they know and trust. And then lastly, cut your client list. Start to look at your client list and begin to put those into buckets, A, B, C type clients, right? Look at those C clients. If you look at them and no matter what you do, you never can make money. You've changed project managers. You've done all you can do to try to do what you can to make money with this client. Quit working for them, right? Then start to focus on those A and B clients, and can you get more work with those A and B clients to make you more profitable? So put your clients in buckets, and I know it's hard to do. A little bit easier when we're all busy. We can say, you know what, I can cut those C clients off. I don't want to work for them anymore. I want to focus on those A and Bs. A little bit harder to do when times are tough, but it's still important, because if you can cut those C clients, even in tough times, and focus on those A and Bs, you'll become more profitable. And improve your fee strategies, right? Don't use past proposals without doing some sort of analysis. Don't just go pull another K through 12 proposal off the shelf and propose that same thing to a different client. You've got to use some analysis. Was that a brand new site? This one's going to be a lot of interior renovations. So use those evaluations. Again, as I said before, calculate those overhead rates annually to make sure that you're including that overhead rate properly when you're putting these fee proposals together. And don't estimate what the client wants to spend, right? Make sure that you're putting the price together of what it's really going to take from an effort. And if the client comes back and says, hey, this is more than I anticipated, what can we do to reduce it? Say, okay, well, let me look at the scope and start eliminating scope before you just wholeheartedly reduce the fee. You know, that's the last thing you want to do. If he comes back and says, I need you to cut your fee by 10%, you can say, okay, fine, but we're not going to include this, this, and this to make that happen. And then don't just make it. Don't just take a guess at what it's going to take. Really do some analysis to know, okay, I really think it's going to take this many hours. We're going to, you know, at this rate, here's what it is, back into it several different ways to make sure you're looking at the fee proposal from a holistic approach and not just putting a number out there to see if the client's going to bite. And lastly, I'll leave you with this. This is one of my favorite quotes. You know, I can tell you, and you're probably going to forget, you know, hopefully I taught you a little bit and you might remember, but until you go out and get involved, that's where you're really going to learn. So take what I've given you, take the, you know, happy to share the PowerPoint, take that back into it. I'm happy to share some handouts that I use in my, you know, my in-person ones, share that with you, and go get involved and try to learn this so you can really begin to take hold of this and grasp it and be a better asset to the firm, and then obviously grow you personally in your careers. So with that, any additional questions, comments, anybody see valuable? Hey, you know, I'd like to do this. I'd like to see this, whatever it is.
I'm excited to put the dollar value to hours for the proposal for our team and kind of encourage leadership to look at it a little differently. So I know that'll be super valuable for us.
Good.
Are there ways you've seen marketing professionals be more billable or utilized on jobs?
Yeah, I mean, it you know, a little bit, you know, there are things that, you know, I think sometimes what I've tried to do certainly as we track, you know, the cost of pursuits and knowing that maybe we can't, you know, wholeheartedly go charge the client for that time. But when I know that it costs me, you know, X amount of money for this pursuit, I can certainly try to roll that into my fee proposal, right? So it may not have been directly billable, but yes, in turn, hopefully I can recoup some of that time. So it makes my multiplier better. So I'm getting a higher fee, but the effort on that project that my technical staff is doing is still what I anticipate. So my profit margins are higher and I can cover the cost of that marketing team. But yeah, I mean, you know, if there's ways that, you know, if somebody needs help in the field, to go document something out in the field, hey, can I go? I'm light this week on proposals. I can go out in the field and help you document this stuff and charge time to a billable project. Just look for those kinds of ways that you can help, charge time to be that, that 10% billable.
Awesome, Chris. Thank you so much for presenting today. And it sounds like there's a couple people that are interested in those handouts in the PowerPoint. So if you could share that with April, we'll make sure that this recording and then your materials get to everyone that participated today, or registered. So thank you again, and thank you to everyone that joined today. I hope you learned something, and you can go and use it now.
Great. Thank you, everybody. It was definitely a pleasure. And again, my information's here. If you have any questions, concerns, don't hesitate to reach out. And I'll definitely share this presentation and then the handouts I use for my in-person presentation, so you have a little bit more info that you can practice with.
Thanks.
Awesome. Thank you.